Bismillahirrahmanirrahim. Hello, my dear friends and students. In this video, I want to talk about the key activities of a finance manager or the functions of a finance manager. There are several functions, but some of them are highlighted here. Number one, for example, forecasting financial requirements. Forecasting means in this case we have to expect the financial requirement of the business. So it means it is expected from a finance manager to find out how much capital is required to run the business. And for this purpose, he should understand first that for what purpose he need capital. Then he can find out how much capital is required for the business. So according to this slide or the books which I have taken, or according to me, if a finance manager want to calculate how much capital is required, first of all, he should understand the purpose of the capital. So the purpose of requirement of capital is divided into two parts. We need capital in the business for acquiring, of course, fixed asset. We need some capital to acquire or to purchase fixed asset, right? Like land, buildings, and so on, that I will explain it shortly. So, number one, he should calculate that how much capital is required to purchase land, building, machines, furniture, and so on. Point number one. And point number two, he should be able to calculate that how much capital is required as a working capital. Working capital means the capital which is required for day-to-day operation of the business. So two type of capital was required. One to purchase the fixed kinds of things like land building and so on. And of course it is not enough and we should have some amount of capital for day-to-day running of the business. For example, payment of salary, payment of, for example, day-to-day expenses, payment of electricity bill, payment of, for example, wages, payment of food expenses, right? All those kinds of expenses which incur routinely in the business can be called as what? Purchase of raw materials, payment for the suppliers, all of these can be called as what? As a routine expenses, and it comes a part of working capital. So now let me give you a simple example here. Fixed asset or this one, for example. For example, we need to purchase land and building, we need to purchase plant and machinery, we need to purchase vehicles, for example, we need to purchase furnitures, tools and equipments, and of course we have to find out the total of all. And for each, of course, we need funds. Suppose let us assume that 1 lakh is required for this one, 50 for this, 60 for this, 40 for this, and 50 for this one. Let us assume that the total of all these fixed assets are equal to how much? 1 lakh. So now we have understood that for what purpose we need capital and how much is required for each and how much total capital that we require for what? For fixed asset. This is one side of the case. On the other side of the case, of course, we have to understand about the working capital as well. So if this much is required for fixed asset, how much is required for working capital? So first of all, before to calculate the working capital, you should understand what is working capital, or you may know it from your previous semesters. This is basically working capital. Working capital, or this is the formula of working capital. Working capital is equal to total of current asset minus total of current liability. And this is called net working capital. From total of asset minus the total of current liability, you will get amount of working capital in order to understand how much is required. So how to find out this one? The total of current asset. Of course, we know what is current asset. Cash is current asset. Bank account is current asset. Account receivable, note receivables, prepaid expenses, inventories, all those things. So of course, we know it from the previous semesters. That is current asset. On the other side, current liabilities, account payable, for example, we can say outstanding expenses, income received in advance, overdraft, short-term loans, all those things can be called as current liability. So from the total of current asset minus the total of current liability, you will get what? Working capital. For example, we assume that we have estimated that the total of current assets required is equal to 4 lakh. And also we assume that the total of current liability, we assume that equal to how much? 3 lakh. So how much working capital is required? 1 lakh working capital is required. Now the question is here, how much capital was required in order to understand it, right? How much capital was required? 3 lakh was required for fixed asset and 1 lakh was required for working capital. Total capital required is equal to fixed asset plus working capital. So Total capital required equal to 3 lakh plus 1 lakh. 3 lakh fixed asset and 1 lakh working capital. So 3 plus 1 become equal to how much? 4 lakh. So in this way, we can estimate that how much working capital is required for the business. Point number 1. Second key activity of a finance manager is this one. Acquiring necessary capital and making optimum capital structure. Point number 2. After understanding that 4 lakh is required, we have to go for these two questions. Where to raise the amount of 4 lakh? Yes, it's very important. Okay, if 4 lakh is required to run my business, so from where can I get it? And second question, how to combine different sources of fund? Of course, there are several sources of fund. How can I make a proper combination of this one? This is also the responsibility of a finance manager. So this is called acquiring necessary capital and making optimum capital structure. So in order to answer this one, first of all, you have to know what are different sources of fund in the business if you want to raise from the market. Source of funds are basically divided into two parts. One part of the fund can be called as the equity, and these are the source of equity, or for example, equity share or preference share. These are the funds which are provided by owner of the business to the business. One type of source of fund. The next type of source of fund is debt. So we have to calculate, or we have to be able to, we have to understand debts also. So one type of source of fund is equity, and the other type of fund is, or source of fund is debt. Debt can be, for example, bond. Then can be, for example, bank loan. That can be, for example, loan from friends and anyone, right? So all of these can be considered as a debt source of fund. Now it depends on you whether, if it, of course, we are talking about the corporation, not about the partnership. So if you like, you can go and issue share in the market, whether you can issue preference share, or whether you can issue, for example, equity share. Preference share or equity share can be called as a equity source of fund. If you like, you can go for this one. Or otherwise, if it is not required, you can go for debt. You can sell bonds in the market. You can sell, for example, you can take a loan from the banks, or you take a loan from the friends, and so on. All of this can be called as what? Source of fund. Now, the next point is, of course, how to combine this different source of fund. The combination of different source of fund can be in this way. So we assume that one type of fund or source of fund is debt, and the other source of fund is equity. The total capital can be made in this way. Suppose 30% from this one and 70 from this one. It's a combination, and this is called capital structure. Capital structure means simply this one. How many percentage of this one, and how many percentage of this one. And optimum means proper combination. Now, there is no proper or optimum combination or a standard for any company, for all companies. Each company should find out its own optimum capital structure. This combination of 30 and 70 might be good for example, for my company. It may not be good for your company. Depends on the size of the business, depends, for example, on the reputation of the business, depends on the volume of the business, location of the business, for example, right? Depends on, of course, the nature of the business, which type of business you have. All these things, of course, affect on the business, and it make a different capital structure for you. Another capital structure, for example, 40 of this one, 60 of this one, 50 of this one, 50 of this one, or 0 of this one and 100 of this one is also possible. But 0 of this and 100 of this one is not possible. So remember this point as well. So depends on you. First of all, you have to find out, of course, the source of fund from where you want to raise this 4 lakh. And second one, how can you combine it? Either from one of them, or you can go for two of them. So this can be called as necessary acquiring necessary capital and making optimum capital structure. The next activity is, of course, after raising amount of 3 lakh, 4 lakh. Suppose we have that amount of 4 lakh in our hands. Now we have to go for the investment, or we have to go for the utilization of that fund. And this is called what? Investment decision. Also, we can call it project planning and evaluation. So in this case, of course, we have to go for the purpose of investment. So if we have estimated that 4 lakh is required and 4 lakh is raised from the market, step 3 is now we have 4 lakh in our hand. So we have to go and make a proper investment in the market. Remember, While making investment, of course, we have to remember two things. So there should be a reasonable return or a stable return in the business. If you want to find out any kinds of investment for yourself, so the investment should have a return, point number one, and the return of that one should be reasonable. Reasonable return means, of course, so it should be according to the standards, according to the market average. It should not be less than the standard. Less than the standard means, for example, usually people make 10 percentage, but you give me only 5. So it's not reasonable. Reasonable means, of course, it should be comparable. It should be somehow similar to the market. And of course, it should be stable. Stable means, for example, it should not be too much fluctuated. Suppose this year you gave me 10 percentage, next year you gave me suppose 20, next year you gave me minus 10 percentage loss, right? So this is called unstable. So you should have a proper stable. One thing. Second thing, which is very important, even before that one, you should consider at the beginning of the investment is this one. You should consider three principles while making your investment: principles of safety, principles of liquidity, and principles of profitability. Point number one, even of course, before talking about the profit, you should consider whether your investment will be safe in the business or not. Investment safe in the business means your principal amount should be safe. At least you should not suffer if there is no profit, right? Point number one. You may expect some profit, but at least your basic capital or original capital or initial capital or principal amount of investment should be safe than things to be considered. And that is the important point that we don't have in our country. Principle of safety is not available here. That is why people are not willing to make investment. After principles of safety, of course, we have to go for principle of profitability. We have to check that whether the project or the investment will provide some profitability for us or not, right? So this is of course available in our country, but because of these principles of safety, people are not willing to go for this one. Why? Because the first priority is given for what? For safety. And the next one is of course principles of liquidity. Principles of liquidity means of course liquid means, of course, there should be enough number of buyers as well as there should be enough number of sellers according to the market. For example, if we give example of currency, suppose dollar is a liquid currency. Why? Because there are unlimited number of buyers and as well as sellers in the market. And if you give example of, for example, ruble of Russia, in our market. So of course there is no much buyer and seller, so we can call it this currency is illiquid. So the point is here that your investment should have some liquidity. It means there should be the second buyer for your investment as well. It means you should not be the first and last owner of that investment. So you should make such an investment that the other people also should be willing to purchase it. If anytime you're not willing to continue, there should be the second person to say, yes, I am going to, I want to purchase your business, right? So these three principles should be available in in your investment. Because of lack of a stock market, basically we don't have, unfortunately, we don't have this liquidity as well. So these two principles are not available. Only one principle might be available and based on conditions. So that is why companies are not willing to make investment in our country. One case. The second thing that you have to consider while making investment is this one. You should apply several capital budgeting techniques, and through these techniques you can understand the profitability of the company in a better way. But of course, we will discuss about these techniques in chapter number 3 in details. But for the time being, these are the capital budgeting techniques. For example, the payback period method, net present value method, profitability index method, internal rate of return. All these are the types of methods that we will apply. And of course, this method, some of them show that how much is the profit in terms of amount. Some of them show the profit in terms of percentage. Some of them show that, for example, within how many years we can recover original amount of investment, and so on. So through these techniques, of course, we can find out the profitability of the business. So this was about what? About investment. Remember once again, the third activity that you have to do is you have to make a proper investment. While making investment, this principle should be considered. Apply the techniques to find the profitability, and of course, your profitable should be reasonable and it should be stable. The fourth activity of a finance manager, which is very important, is management of income or dividend. Let us assume that you have run the project and you suppose made 1 lakh profit. If there is 1 lakh profit, the question is, for example, how you can manage this amount of 1 lakh. So the management of this amount of 1 lakh is also one of the responsibility of a finance manager, right? For example, I've given a simple example here. Let us assume that the profitability of the business at the end of the year is equal to 1 lakh. So the finance manager may manage the profitability in this way. For example, out of 1 lakh, let us he assume that 50,000 should be given as a dividend. If you do not understand, for example, what is dividend, dividend means when the joint stock company divide its profit for its shareholder, this can be called as what? As a dividend. And if the joint stock company do not distribute profit and maintain in the business, that can be called as what? As a retained earning. So let us assume that the company has decided that to divide the 50,000 for the shareholders out of 1 lakh and retain 30,000 in the business, maybe for the future expansion, maybe for some emergency cases and so on. Total become equal to how much? 80,000. And also he may decide, for example, to repayment of loan, to repay the loan. 15,000 of this one might be used for the repayment of loan. And also, for example, they may decide that out of this 1 lakh of profit, suppose it might be a huge amount of profit, and all this profit was because of this hard working or efforts of the employees or efficiency of the employees. So let us have or let us take care of those people as well. The company may divide some of the profit or some percentage of the profit as a bonus to the employees as well. So in this way, we can manage our income or we can manage our dividend. So we can call it income management. Also, we can call it dividend decisions in the business. So in this way, the finance manager can decide that how much of the profit should be used for what purpose. Suppose 50 for this, 30 for this, 15 for this, and 5 for this. So total become equal to 1 lakh. So the management of profitability in the business is one of the responsibility of a finance manager. The next key activity of a finance manager is this one, liquidity decisions. Also, we can call it cash decisions, or also we can call it what? Working capital management or working capital decisions. Here, the finance manager basically should understand that how much working capital should be maintained in the business. As I pointed out and in the first slide, that a business need capital for working capital as well as for fixed asset, and also I have mentioned the formula for working capital. So now from that formula, the uh, financial manager or finance manager should calculate that how much working capital is required for the business to run the business. And there are basically three situations for the finance manager. And the finance manager can decide any one of them. So any of these situations have their own advantage as well as disadvantage. Let us assume the first one. If current asset is more, for example, we calculate that suppose 1 lakh is required to run the business or operation of the business. Suppose we assume like this. Suppose we have calculated that in order to run the business, 1 lakh is required. How much is required? 1 lakh is required. But finance manager, for example, raised 1 lakh 50,000. How much is raised? 1 lakh 50. So this goes for the first condition if current asset is more. It means if current asset or working capital is more than our requirement. If current asset is more, so what are the effect of this one? Then the liquidity will be less. Point number one, liquidity will be more. If current asset is more, liquidity of the business will be more. Liquidity of the business will be more. Of course, they will have more cash. Why? Because requirement is 1 lakh, but you have maintained 1 lakh 50,000. So it is required, for example, let's take another example. It is required to maintain only 2,000 in your pocket, but you have maintained, for example, 50,000. Definitely you have more cash. So liquidity will be more, which cause the less profitability, and because of what? Because of idle funds. If you maintain more cash in the business, of course, liquidity will be more, but the problem is that the profitability of the business will be less. Why the profitability of business will be less? Because of what? Because of idle funds. Idle funds means the funds without usage or the funds which are not used for the operation. Let us check this one. 1 lakh was required, you raise 1,50,000. So definitely 1 lakh is used for this one. 50,000 is of course idle funds. And for that 50,000, definitely there is a cost. As we said in the previous slide, so if you want to raise funds from the market, of course you have to pay some cost for that one. So nothing is free in the market. So if nothing is free, of course there is a cost for this amount of 1,50,000, but of course you use only 1 lakh of that one. So let's take like this. You pay cost for 1,50,000, but you receive only, for example, income from this one. Or let's take another example. You have, for example, 4 buildings. Suppose we can say you're working on a commission basis. You have taken 4 buildings to provide it on rent basis, but of course you also pay rent for owner of this building. You pay rent for 4 buildings, but you have given on rent only 2 of these buildings. So definitely, finally, the cost of this building will be more. Why? Because you pay cost for 4, but you use only 2 of them. So this, and that is why the profitability of the business will be less. Point number one. Point number two is regarding the second one. If requirement is 1 lakh, but you maintain only how much? 20,000, less than the requirement. So that is why it is said if current asset is less. So current asset is less. Less means less than the standard. 1 lakh is the standard, but we maintain only 70,000. Then what is the cause or effect of this one? Liquidity is less, of course. Liquidity is less. Why? 1 lakh is required. You maintain only 70, which causes to less profitability. Oh, again, there's a problem. If we maintain more, also less profitability. If we maintain less, also there's a less profitability. Why this time less profitability? This is because of shortage of fund. Yes, in this case, we face shortage of fund in the business, right? We face shortage of capital or working capital in the business. Because of this shortage of funds, we cannot take the advantage of some opportunities. If there is not enough money in the business and you cannot take advantage of some kinds of opportunities, of course, finally the profitability of the business will be less. Let me give a simple example of opportunity. For example, your supplier may call you that if you want to purchase something on cash, pay me suppose only 50,000. But if you want to purchase this one on credit, and credit of suppose 6 months, then you have to pay suppose 60,000, right? In this case, if there is no shortage of fund in the business and you have available cash, you can purchase that good on credit on cash basis for 50,000 instead of 60, and you make a profit of 10,000 here, right? So the same like this, there are several other options that you can have it. Option number three is regarding this one. 1 lakh is required and 1 lakh is raised in the business. And this is called if current asset is proper. Proper means, of course, optimum. It means just enough to the requirement. Then the liquidity is optimum. It means just the liquidity is whatever it is required. And which cause more profitability. Why more profitability? As a result of proper usage of funds. In this option, of course, as it is optimum, the profitability of the business will be good. Why? Because in this case, the working capital is not more than the requirement as well as not less than the requirement. So these are the three situations that we have in the theory. Remember, guys, once again, I want to tell you this point that these are the kinds of theories. It may not be exact for each type of business. Once again, it depends on the nature of the business. It depends on the reputation of the business. It depends on the age of the business, whether the business is a new business or it's a existing business. Remember this point. Usually, the businesses who are the new business usually they go for the first options. Why? Because they think that the companies or the financial institutions or the banks may not trust on these people, and that is why they should maintain a extra amount of money with themselves for some emergency cases. But on the other side, if the company is an existing company, if the company has, for example, line of credit, they have much contact with the banks, It means it is very easy for them to raise funds from the stock market, take loan from the banks and so on. Usually these people will take or will maintain less working capital with themselves, and if they require, so easily they can raise from the market, right? So these are the situations. Or let me give you another example. Suppose if you're, for example, near to your we can say home, or near to your flat, so you may maintain, for example, only 100 or 200 in your pocket. When you go to the town, for example, you have to maintain suppose 500 Afghani with you. When you go, for example, to another province, you have to maintain suppose 2000 with you. Why? Because the people may not know you. When you go, for example, to Pakistan, you have to maintain, for example, 20,000 at least. When you go some other countries which is farther away, then you have to maintain suppose $1,000, which is, for example, more than 60, 70 thousand Afghani, right? So it depends on the situations. We cannot say always it is the same formula for the companies. These are the liquidity decision of the business. The sixth one is, of course, analysis of financial position or performance. After end of the year, when we performed or when we finished the operations, so we should not stop our operation as a finance manager. We have to go for analyze and interpret the financial position as well as performance of the company to check that how was the performance of the company, compare with the previous year, compare with the last 3 or 4 years, compare with your competitors, find out the weakness and strengths of the business, find out the opportunity and threat. It means go for SWOT analysis of the business. And for that purpose, different techniques are there. For example, comparative analysis, common size analysis, trend analysis, cost volume profit analysis, ratio analysis, cash flow, and fund flow. I'm sure you have gone through most of them in financial management. So these are used for financial manager to analyze the financial position of the business, whether it was good or not. And the last one is helping in valuation decisions. Valuation means finding the value of the company, and of course, when we require this one, the valuation rates especially required at the time of merger and acquisition. Merger means when two companies join together and make, for example, the third company. Suppose A and B company join together and make, for example, C company. This is called merger. And acquisition simply means when one company purchase or acquire another company, that can be called as a acquisition. So before to acquire the company or before to merge one company with another company, first of all we should know the value of each company. For example, my company want to purchase your company, right? So it is the responsibility of my finance manager to determine the value of your company, and also it is the responsibility of your finance manager to determine the value of your company. Why? Because first of all, you say, for example, how much is the price of your company, and then we negotiate to that how much we can offer for you. So this is the case. And of course, even in the case of merger, before to combine two company, the owner of these two business has to determine the value of each. Suppose there are two companies, A company and B company. After analysis, we found that the value of one company is 40,000 and the value of another company is suppose 60,000. So when they join together and make the third company, in the third company, we should know the percentage of ownership of each one. So out of ownership of C, 40% may go for A company and 60% may go for B company. According to this course outline, basically these were the key activities of the finance manager. But let me tell you, my brothers, you may not have only this one in our economy, or we can say in our market. Check the financial or finance manager positions in the job sites. For example, go in the jobs.if or go in the Akbar. You may not find out most of this one. When you go, these are basically the standards for the corporations, but as most of the companies are not standard, so they may not have most of these, but of course some of these are required. But let me tell you, when you go in the jobs, when you go in the sites and open the job description for the finance manager, you will find out these things. For example, You are required to make a budget for the business. You are required to prepare the budget, to review the budget, to apply the budget, and also to find out the variance in the budget. This is your responsibility. Your responsibility is to prepare the payroll, calculate the payroll, and of course, and manage the tax of the payroll and so on, and pay tax for the government. Calculation of tax is your responsibility. Managing the file or having a proper filing system is your responsibility. Preparation of bank reconciliation statement is your responsibility, of course. Then for example, managing cash in the business, as I have mentioned here as well, but in the business we usually talk about the PT cash is your responsibility. Payment for the bills is your responsibility. Taking care of all these procedures that should be genuine and it should be accurate is also your responsibility, right? So, and of course, maintaining a good relationship with your customers, maintaining a good relationship with the teams, having a proper responsibility there, of course, a proper responsibility with the banks and so on, calling a bank statements, all these points are your responsibility. It is not enough for you to just see that, yeah, these are my responsibilities, and you know that when you go to the job, so you cannot find out most of this one, right? So what is my suggestion? Please go in the job sites. Each one of you download one job description or two or three job descriptions. Or let's go like this. Please, all of you, download one job description. See one job description for profit-making organization for position of finance manager, one for non-profit, one for the government, and one for international organizations, and come back with the points that what you got there, and please equip yourself with those requirements which are needed for the position. Thank you. For the further informations, please go to my YouTube channel by the name of Mohibullah Zamani and search. And please don't forget to subscribe for the coming videos. Thank you.